Hi, everyone. I'm Rosemary Miller, and today I have Hank Tucker, a Forbes Money and Markets reporter, to tell us how this asset management firm has beat the stock market for nearly a decade. Thank you so much for joining me, Hank.
Thanks for having me here.
So, Hank, Marshfield Associates, you said it's outperformed the markets for almost a decade, but mostly they only invest in simple stocks. Could you tell us what's their strategy?
Yeah, this is a concentrated investment firm that they're very picky. They only have a portfolio. They typically stay between 16 and 20 stocks. They have 17 in there now. And they try to stick to, pretty large, mostly well-known, conservative investments. Now, a lot of the stocks in their portfolio now are auto parts retailers like AutoZone and O'Reilly, or MasterCard and Visa, or Domino's Pizza. And they've all performed, pretty well, and they only add, one or two stocks each year, sometimes, one or two more than that. But they're very diligent and disciplined about, selling when the stock hits their sell price, and they try to look for opportunities to buy and they have a cash pile on the side also, which is kind of unusual for an investment firm to be able to be opportunistic when they see a stock that goes below where they think it should be trading. So,
speaking of opportunistic, they were quite opportunistic with Chipotle, right?
They
Could
were.
you tell us about that?
Chipotle, a lot of us remember in 2015, 2016, end of 2015, when it had a lot of food poisoning scares, E. coli outbreaks. There was norovirus, salmonella in a lot of its stores. As a frequent customer myself, it made me, I think, a little concerned at the time. And, investors were also worried as customers were fleeing. Sales were kind of declining, profits. There was a lot of concern about it. The stock went down a lot. And Chris Nimchevsky, the founder of Marshfield, had seen this kind of play out before when these kind of fast food chains have scares like this. Jack in the Box back in the 90s actually was responsible. Well, I don't know if legally responsible, but it's undercooked burger patties. There was E. coli and 4 children died back then. And its stock went down to around $2 per share, and it survived, and now it's over $100, or a couple of years ago it was. And so he'd seen that play out before. He had Yum Brands, which owns KFC, Taco Bell, for 22 years, and had been through a couple of these cycles. So Marshfield bought a lot of Chipotle stock over the next couple of years as it kept declining, and once it turned around to 2018, 2019, 2020, the sales picked back up and it started really growing again, and the stock multiplied by more than 300%, 4 times where it had been at its low point, and it made Marshfield a lot of money.
So I saw you describe their portfolio as a conservative portfolio, low volatility.
Mm-hmm.
Why is that?
Well, they really avoid sectors like tech stocks and energy and commodities also, even though energy performed really well last year. But something that's cyclical and depends a lot on external factors like oil price and whatever conflicts are going on, and that, so they stay away from those. They say it's kind of hard to make money in those kinds of industries. Tech stocks, we all know a lot of those companies are not profitable. Investors are just betting on the hopes that they'll become the next Amazon or Apple or Google. And sometimes they tend to go down a lot when those hopes are not fulfilled. So he says they've tried everything at least once, and learned where to avoid and where to put more of their money. And so now they're on more established insurance companies, financial services, retail, restaurants, and those tend to be less volatile. Less risk of losing most of your money that you put in, and they've never had a down year, at least since they launched their mutual fund 8 years ago. They've been managing separate accounts before that, but their mutual funds never had a down year, and they try to keep up in the good years and outperform in the bad years for the rest of the market, and they've done well.
So I heard you mention retail as kind of a low volatility, but what about the brick and mortar stores? So they have, AutoZone and O'Reilly. That kind of feels outdated to me. What are your thoughts on that?
Yeah, well, those are 2 stocks they bought in 2017 when that was around a time in the market when most of the stock market was going way up, but retailers were lagging way behind and declining in a lot of cases because Amazon was just growing like crazy and was kind of absorbing. Everybody thought just e-commerce was the future, and to an extent it definitely is, and people move most of their shopping online. These auto parts stores that Marshfield identified as just kind of part of that trend, that they didn't really belong in that trend, though, that people still did have to go to these stores. Nobody wants to buy a car battery on Amazon. When your car breaks down, you got to actually go in person.
I see your point. You go into the handyman.
And you go find the mechanic and make sure they do it for you.
Mm-hmm.
And that was a time when those stores, profits had kind of slowed down a little bit, at least their growth. And Nimshevsky and his business partner and wife, Elise Hoffman, I talked to both of them. They said that those stocks' revenues and profits actually are more dependent on just the weather and how many miles people are driving, and they were declining during a time that was more moderate. People need replacement parts more often when there's extreme cold or extreme heat that can cause more wear and tear on cars. And then those weather patterns reversed. Obviously, we see a lot of extreme heat waves or freezes recently that make drivers, do some maintenance in the cars more often, and they've gone to those stores, and those stocks have, multiplied, several times the last few years, and their profits and sales are, have been very impressive, and it's made Marshfield a lot of money.
So, in a nutshell, could you name what you've gathered to be like their top 3 investing strategies?
Yeah, so they look for really resilient companies. They use that word resilience a lot, resilient industries. We talked about the food poisoning situation. So they're willing to buy when others are fearful and ride out the rest of that growth cycle. They're very patient, I think. Their average, they hold stocks on average for about 8 years, which for a company that doesn't really have many stocks in the portfolio there's not that much turnover. And they're just really disciplined and care about price, and they pay attention to sales growth and margins, and they come up with an intrinsic value estimate for every company they buy or that they're looking to buy if it goes below a certain price. And they're very disciplined about their philosophy, and they don't really stray from it based on what their gut tells them or other things like that.
They do not stray from their philosophy. All right. Thank you so much for joining me, Hank.
Thanks, Rosemary.